Hello everyone, this is Tejashwini. Let's do the revision of PGBP Part 2. Part 1 is already been uploaded and this is applicable for your Jan 2025 exam. Now, Part 1 is already uploaded. You can go and watch that video and this is going to be a Part 2. Other deductions, that is your Section 36. Section 36 subsection 1 clause 1 speaks about insurance premium which has been paid. Now, if you're paying the insurance, if the employer is paying the insurance premium for the stocks and stores, it is going to be allowable. If it is paid for other purpose, it is not going to be allowable as your deduction. Remember, the premium paid by the employer for the health insurance of employee, it is going to be allowed as deduction provided the premium paid by employer is other than cash. If he pays in cash, then it is not going to be allowed as deduction for the employer. It is going to be disallowed. Clear? Bonus and commission paid is going to be allowed as deduction. Interest on borrowed capital. Remember, there are 2 points. Interest on borrowed capital, you might be paying for the capital asset or you might be paying for your working capital, normal requirement. If you are paying the interest on the borrowed capital and that capital is being borrowed for the purpose of buying an asset, a machinery. A machinery and asset is being purchased from that borrowed capital. Till that asset is capitalized, till that asset is capitalized in the books of accounts, what the cost which is involved, we are going to capitalize. We are going to add everything to the cost of asset. Similarly, whatever the interest which is being paid or payable when the borrowed capital is for the purpose of machinery, till that point of time we are going to consider and add it to the cost. After the asset has been capitalized or recorded in the books of accounts, then later on you are going to transfer it to the P&L account as revenue expenses. Clear? That is what. See, if it is interest from the date of borrowing till the date on which it is first put to use, till the date it has been capitalized, included in the cost of asset. Interest after such a period, once it is capitalization is considered allowable as deduction as business, that is while computing your business income, nothing but your allowable expenses. Section 36, subsection 1, clause 3A speaks about discount on zero coupon bonds. Discount on zero coupon bonds, remember, zero coupon bonds are those bonds where it doesn't carry any coupon rates or interest rates. But it is issued at a discounted price, but it is redeemed at a par value or it can be redeemed at a premium also. So now, in case of zero coupon bonds, whatever the discount amount on which you are issuing, suppose 100 rupees is the value of the one bond. You're issuing it at 90. So the 10 rupees is something which is issued at discount. This discount is your expenses which you are going to amortize or which you are going to apportion it till the life of the bond. Everyone, till the life of the bond. If the bond is for 5 years, you are going to consider the expenses, corresponding expenses also for the respective 5 years. I can't go in depth about it. In depth will be done in your regular session, in your regular classes, but we are going to do it at revision basis. So we are keeping it very crisp and clear. Clear? Now, Section 36 clause, subsection clause 5 and clause 6 speaks about contribution to provident fund and other funds. Contribution which is made by the employer is going to be allowed as deduction. Remember 4A. Employer's contribution to in the account of the employee under pension scheme of 80 CCD, it is going to be allowed as deduction, but it is allowed restricted up to 10% of the salary of the employee, and salary for this purpose would be basic plus DA, and all the other allowances and perquisites are excluded. Only these two are considered. Simple, basic plus DA. Now, the next point becomes absolutely important, that is section 36, subsection 1, clause 5, wherein whatever the amount which is received by the employee as a provident fund, by the employer's contribution of the provident fund or employer's contribution to any funds of the employee to the employee account will be allowed as deduction for the employer only if such fellow pays it within the before the due date. Now, let's take an example. Provident fund, all of us know there will be two contributions involved. One is employer contribution and one is employee contribution. Employer contributing the money, employee contributing the money. Employee's money, what the employer is doing is deducting the employee's money, certain amount as provident fund and is keeping in his pocket. He will pay it within the respective due date of that respective fund. If he doesn't pay within that provident fund due date, not income tax return due date, that is provident fund due date, then it is going to be considered as his income. First of all, he should just collect and he should pay. If he is not paying within time, then it shall be considered as his income and it will be added to his income tax. It will be added to his PGBP as income. Due date here means to state it is going to be the respective due date. Clear? No. Section 36, subsection 1, clause 6 speaks about the bad debts, wherein first of all, bad debts, if it is already, in order to get the bad debts, first of all, you should have done some sales. There should be some debtors. That sales, if it is already recorded as your income, then the bad debts will also be allowed as expenses. Clear? Recovery of the bad debts subsequently will be recovered, will be considered as your income, it will be considered and it will be added to your PGBP. Section 36, subsection 1, clause 9 speaks about expenses on family planning. 1 by 5th of such capital expenditure can be allowed as expenses only to companies. Remember, it is only and only to companies. So, section 36, subsection 1, clause 15, deductions in security transaction tax is going to be allowed as deduction only if it is the company doing certain company's business, nature of business is trading in shares. Only then SCT is allowed, otherwise it stays allowed. Commodity transaction tax also goes in a similar way. Section 37 speaks about residuary expenses, people. What do I mean by residuary expenses is that any expenses which is not covered either from section 30 to 36, it will be coming under section 37 provided he has satisfied two condition. One, the expenses are revenue in nature and expenses are incurred for business purpose. Both conditions satisfied, you will get those expenses as deduction under section 37. Clear? Now, conditions for allowances. So, this would be the see now. Remember, expenses which is incurred on the Keyman insurance policy taken by the employer, it's going to be allowed as deduction. Corporate social responsibility expenses. What do I mean by this? Corporate social responsibility, CSR activities. If you are if you are doing any CSR activities, remember it is going to be disallowed. Remember this book. Advertisement in sovereigns of the political party shall be disallowed under PGBP but allowed as deduction under your chapter 6A. It is allowed as deduction under your chapter 6A. Clear? Section 40 speaks about inadmissible deductions, wherein Section 40A clause 1 speaks about any interest, royalty, or fees for technical services where it is payable or to be paid to a non-resident or to a foreign company or to a person outside India, wherein TDS need to be deducted, but the TDS is not deducted. TDS was supposed to be deducted, on which TDS is applicable, but TDS has not been deducted, or such tax itself has not been deducted, but after deduction, he failed to pay before the due date of return filing under section 139 subsection 1. 139 subsection 1 speaks about your return filing due date. For individuals, it's going to be 31st July. That is for the companies having the form, need to submit form 3 CEB, also having associated enterprises outside India. The form would be November. That is, the due date would be November 30th. For other tax audit situation cases, wherein tax audit is applicable, it would be 30th of October, 31st of October. In all the other cases, it is going to be 31st of July. Yeah. Great. First of all, if you're filing if you have made the tax payment, deducted the tax, or if you have not deducted the tax, deducted but not paid within the due date, then 100% of such interest royalty and 100% of such payment shall be disallowed. Remember, 100% of such payment. But now what happens next year? PY 2024, next year PY 24-25, you pay the amount after the due date. That is after the, let's consider on December 2024, December 2024, you made the payment. That falls in PY 24-25. It will be allowed as deduction in the year 24-25. Whatever was disallowed earlier will become allowed in the next year. The same point and the similar point would be applicable for 40A clause IA, wherein this TDS amount, whatever, is supposed to be deducted but not deducted, but not paid within the due date of 139(1), then if it is payable to a resident, it comes under disallowance of 30%. Clear? Same thing would apply. Next year, if that fellow pays, next year would be allowed as a deduction. Whatever is disallowed earlier, it will be allowed as your deduction over here. It will be allowed as deduction over here. Clear? Now, This any tax levied on any profits, any taxes which is levied on profits, any PGBP surcharge says any taxes, income tax which you paid is disallowed. Any salary paid outside India to a non-resident without TDS deducting disallowed. Any funds which you are paying for a benefit of employee disallowed. Any perquisite tax on perquisite which you have made on behalf of employee is not deductible. That is, you have made the payment. Employer has made the payment of tax on perquisite to the on behalf of the employee. It is not going to be allowed. It will be disallowed. Clear? Section 40B speaks about the firm making any, that is what would be the deduction that is allowable to the firm. The normal provision is concerned, but there are certain interest and the remuneration amount wherein you to consider over here in case of firm. Any remuneration paid to a non-working partner would be disallowed. Remuneration to a working partner which is not at all recorded, that is not authorized in the deed at all, it is going to be disallowed. Everyone, remuneration to the working partner is authorized by the deed, but this year you have only recorded the deed. Last year in the deed you have stated, okay, we are going to pay it for the earlier periods also. Even though it is recorded by the deed, but it is relating to earlier years, it is going to be what? Disallowed. Interest of any partner in excess of 12%, it is going to be disallowed. If it is up to 12%, allowed. Excess of 12% is going to be disallowed. If the partnership firm is paying 14% as the interest rate for to any partner, giving the interest of 14%, up to 12% is going to be exempted. That excess of 2% would become taxable. That is, it would become disallowed. Disallowed means added back to your income. That would become taxable. Clear? Remuneration of a working partner in excess of your prescribed limit. What do you mean by in excess of your prescribed limit is that, first of all, remuneration, what you're going to do is that you're going to consider or calculate the book profit. How do you calculate the book profit is that first you'll calculate net profit as per P&L. You will do all the other adjustment which is there in your normal PGBP computation. Then you will add back your entire interest, add back your entire remuneration. Now you will get the profit before interest and remuneration. Now you will subtract the interest as per your P&L account. That is, you will not as per your P&L account, people. Now you will subtract your interest as per your income tax, which is allowed. That is up to 12% you are going to disallow. Sorry, up to 12% you are going to subtract. Remaining that, suppose if it is 14%, 14% minus 12% leads to 2% only. No, you can do one net figure or you can write it separately. Both are accepted. Then you will get the book profit before remuneration over year. After recording the remuneration over year, what you will do is that book profit on the first 3 lakh of the book profits or in the case of loss. You got this? If the book profit is 4 lakh rupees, 4 lakh of book profit, that is 1,50,000 one amount or 90% of the book profit. So 3 lakh into 90% leads to 2.7 lakh. 2.7 lakh or 1.5, whichever is higher. Obviously, it's 2.7. Or on the balance of the book profit, it is going to be 60% of the book profit. On the balance, suppose if it is 7 lakh, 3 lakh is considered here, remaining 4 lakh multiplied by 60% of the book profit would be considered. Clear? Next. Next point would be expenses or the payments not deductible in certain circumstances. Expenses or the payments not deductible in certain circumstances would be the point where it 48 any payment you are making to a relative in excess of the fair market value which is considered to be unreasonable will be disallowed under section 40. 40A3 states that any payment which you are making in excess of more than 10,000, not exactly exceeding 10,000, that is if you are making the payment in cash basically. That is in professional terms we call it as other than account pay check, account pay draft, electronic, any other clearance, electronic clearance mode. If you paid in cross check excess of 10,000 rupees, it will be disallowed. If you paid in bearer check, it will be disallowed. If you paid in cash, it will be disallowed. That's the point under section 40A. The 10,000 limit is increased to 35,000. Very, very important point. When the operations, when the payment is being made to transport operator, when the payment is made to transport operator for flying, hiring or leasing of the goods carrier. Clear? Section Next, section 40A7 speaks about you making the disallowance of gratuity. Disallowance of the provisions of the gratuity, that is, it will be disallowed. At provision, all the provisions for that matter, anywhere it is not considered as deduction under your PGBP, it is going to be added back, disallowed, and then whatever the actual payment you are going to make it as will be allowed subject to 43B. deductions subject to 43B section. Clear? 40A9 speaks about any contributions of the employer to trust, fund, trust, etc. It will be disallowed. Profits which is chargeable to tax. See, whatever the tax liability, first of all, one fellow had given me loan of 1 lakh rupee. And after some 2 years, that I'm keeping it as loan liability in my books of accounts. After 1 year, after some 2 years, that fellow says that don't give this 1 lakh. Now that 1 lakh rupees is my income, no? I'll make it as taxable in the year when that liability is been waived off. Liability is been ceased to exist. Whatever is the sale of capital asset, balancing charge and recoverability of the bad debts, it will become taxable. Any brought forward loss of the defunct business is going to be taxable. Now, section 43A changes in the rates of exchange of the currency. What you're going to look into is that any increase or decrease in the liability, actual cost of the asset, capital expenditure made, etc., would be considered as your expense. Clear? Would be considered in your P&L. Section 43B, which is going to be absolutely important, that is, certain deductions can be made only and only on the actual payment. That is, if you make actual payment of this following, only then you can. If it is payable, then it is not available. If it is actually made the payment within what date? Within 139 subsection 1 due date. For PY 23-24, the due date would be 31st July, 31st of October, and 30th of November 2024. If it is made within that respective due date, whichever is applicable to you, then the deduction would be allowed under section 43B. What payments? These payments. If not, it would not be allowed. Clear? Out of those, duties, tax, cess, or fee payable by the employer by way of contribution to any provident funds, superannuation fund, or gratuity fund, bonus or commission, interest on any loan or borrowing from any public financial institution, interest on any loan or borrowing from any class of NBFC, interest on any loan or advance from the scheduled bank. Basically, interest paid, basically any amount paid to the employees, tax duty paid to the government, and whatever is the small and the medium scale enterprises which is beyond the limit, that is micro, small and medium enterprises, and it would be allowed as deduction only if the previous year, that is it will be allowed as deduction if it is paid in the previous. See, the due date would be mentioned as for the small and medium enterprises is that in case of the agreement between the MSME and the vendor exist, then it is going to be 45 days. If there is no agreement exists, you have to make payment within 15 days from the date of your invoice. If you doesn't make the payment, then it is going to be added as your liability. Whichever year, that is after the due date, if you make payment, whichever year you have made the payment, that year it would be allowed as deduction. If you have not made the actual payment, it will be disallowed in that year, added as your income in that respective year. Whenever you are making any conversion of interest into loan or borrowing or debenture people, that is, let's consider you had a loan of 10 lakh. Okay. Interest accumulated which you did not pay is 5 lakh. Now you went to the bank and stated, I want the restructuring of my business to happen. That is, I want the loan to be restructured. Now make the entire 10 plus 5 lakh as 15 lakh. I will pay within this 25 months. So every month I'm going to pay how much? 60,000. Now tell me people, out of this 10 lakh, is that entire 15 lakh whatever you got is your loan amount? No. 10 lakh is your loan. 5 lakh rupees is your interest only. If I consider 10 lakh rupees divided by 15, I will get 67%. This 67% is representing my loan amount. What about this interest? 33%, it is representing my interest amount and it is allowed as deduction in whichever year it is paid. So out of the 60,000, 33% would be allowed as deduction and 67% would be considered as loan. Clear? Now, section 43CA speaks about your stamp duty valuation for your plant, that is your land and building. Full, what will are you going to consider your full value of consideration would be the point. Remember, if your SDV is up to 110% of the consideration, then actual sale consideration would be considered as your stamp duty value. If SDV is greater than 110% of the consideration, your SDV would be considered as your full value of consideration. If SDV is up to 110% of the consideration, if your SDV suppose is 1 crore And your pen consideration which you have charged is 90 lakh. 90 lakh multiplied by 110% leads to 99 lakh, right? This 99 lakh as STV is less than or equal to. If STV is less than or equal to, or if the STV, in this case, STV is 1 crore, 110% of the consideration is leading to 99 lakh, you have to consider STV as your full value consideration. Clear? People are making super quick revision over here, not in-depth explanation. Okay, this has done with an intention of doing a revision very quick. Now, when it comes to your STV people, when it comes to your STV, which STV you need to consider? There will be two STVs. If the date of agreement and date of registration are two different dates, then there should be two different STVs. If that is the case, what happens? The STV as on the date of agreement itself would be considered is if the whatever the advance payment which would be made, whatever, some 10 lakh, 1, 2 lakh, 3 lakh, some 1 lakh, whatever is the consideration being considered, everything we are going to consider it in the part of consideration itself. That is electronic modes we are going to consider on or before the date of agreement. On or before the date of agreement, if I have received any advance in account pay check, account pay draft or any other clearance mode, that is other than cash, SDB on the date of agreement would be considered for the purpose of calculation. If if you received in the form other than account paycheck, account pay draft, or you have received in the form of cash, then the sale consideration SDV as on the date of registration would be concerned. Clear? This is going to be a 43C. Next, 44 section 44 double A speaks about compulsory maintenance of books of accounts. Who shall maintain this compulsory maintenance as per the books of accounts is that notified professional, that is legal, technical services, medical, interior decorations, engineering, film artist, architectural profession, company secretary, accountancy, information technology, and professionals. All these people would be considered for the purpose of maintenance of books of accounts. When in case of prescribed books of accounts or other documents to be maintained, cash book, journal, ledger, carbon copies, original copies, all these three things would be considered. That is, prescribed books of accounts which you need to maintain is so much. And in case of medical professionals, they need to maintain an additional book, additional maintenance, that is, a daily case register in Form 3C and the inventory records of stock of drugs, medicines, and other consumables. They need to maintain this such information. And this minimum of 6 years need to be maintained. It need to be maintained for a minimum of 6 years from the end of the relevant assessment year. Section 44 double A subsection 2 speaks about maintenance of books of accounts other than whatsoever the notified professionals were mentioned under 44 double A1. Other than those people. So, if that is the case, if the person are carrying on any specified profession for that matter, profession, you should make sure the gross receipts exceeds 1.5 lakh in all of the three previous years. In all of the three preceding the previous year, if PY 23-24 is applicable, preceding the PY is going to be preceding 3 years. Before 23-24, these 3 years, all the years you should be exceeding how much? 1.5 lakh. Clear? And if you exceed it, then you have to maintain the books of accounts as prescribed as per Rule 6FF. It's not F2, this is 6FF. Everyone, if you have not exceeded 1.5 in any one of the year, then you have to maintain such books of accounts where the assessing officer feels comfortable. Okay, so much information we are comfortable with. Everyone. And now the person carrying on any non-specified profession, any other thing apart from that, then it needs to maintain the profit from such profession or business which exceeds 1,20,000. That in case of individuals and professionals, 1,20,000 is replaced by 2,50,000. Or he should be earning a total sales or turnover which exceeds 10 lakh, and this 10 lakh is replaced by 25 lakh in case of HUF and individual. And in any of the three preceding previous year you have exceeded, then very well you need to maintain such books of accounts where the assessing officer feels okay. If this condition is not satisfied, any one condition is not satisfied, you need not maintain the books of accounts at all. Clear? The next section 2271A speaks about the penalty. If you have not maintained the books of accounts penalty, then you need to pay a penalty of 25,000. Next section 44AB. Section 44AB speaks about audit of accounts of certain persons carrying on any business or profession. Very, very important section. Tax audit sections. If you are a person who is carrying on any business and you are having the turnover exceeding 1 crore, 1 crore in the relevant in the respective PY, wherever you are applying for tax audit, then you have to consider, then you have to maintain the books of accounts and you have to get your books of accounts audited under section 44 AB. Tax audit is necessary. If you are carrying on any profession, the gross assets should be exceeding 50 lakh in the relevant PY. Turnover shall be, see that whatever 1 crore which I've told for the business, 1 crore will be replaced by 10 crore. It is not for profession, huh? It is only for business. That 1 crore will be replaced by 10 crores provided you satisfy both the condition. Remember, this is and clause over here. Both the conditions should be satisfied. That is, aggregate of your cash receipts in the relevant PY is less than or equal to 5% of the total receipt, and the cash payments, cash receipts is less than or equal to 5% of the total receipt. Cash payment is less than or equal to 5% of the total payments. Then, out of the total payment made, cash payment is up to 5%. Cash receipts, total receipts receive, cash receipts is up to 5%. All the both the conditions satisfied, then you have to maintain your books of accounts. Then you have to get your books of accounts audited. And remember one point, people. If any, if 44 AD you have applied 44 AD, then section 44 AB would not be applicable. Remember this point. Section 44 AD speaks about the presumptive taxation, wherein it is applicable for individual resident, HF, partnership, but not for LLP. Remember. And it is not at all going to be applicable for the person who is specified under 44 AA, because those people, we have a separate section 44 ADA as a presumptive taxation. And this person earning, if you are earning any commission or the brokerage, or if you are in the agency business, or if you are the person who are getting covered under 44 AE, then you can't opt in for 44 AD. And the eligibility criteria for the turnover is that your turnover should be up to 2 crore rupees in case of 44 AD. Everyone, estimated income, that is turnover or the gross receipts of the income. If it is through bank, it is going to be 6% of the turnover. And if it is in any other mode, the taxable, that is your estimated income that you are providing in any other mode, is going to be 8% of the turnover. Through bank, it is going to be 6% of the turnover. Clear? Now, section 44 ADA speaks about the presumptive taxation, wherein the eligible assessee, that is resident or individuals or HF, it is not LLP. The gross receipt should be up to 50 lakh in order to opt for 44 ADA. If it is exceeding 50 lakh, you can't opt for 44 ADA. That is in case of profession. Clear? You can declare higher income under 44 AD under 44 ADA without any point. That is, you can provide higher amount as your taxability. But if you are providing a lower amount, remember, you have to get your books of accounts audited mandatory. Clear? Now, section 44 AE speaks about business of flying, leasing or goods carriage. The eligible assessees are those people who are owning not more than 10 goods vehicle. Not more than. Exactly, can you own 10? Yes, you can own exactly 10. If you're owning more than 10 at any time during the previous year, not only at the during the end of the year, any time during the previous year, if you're doing this, if you're having this, if you're having this goods carriage, then it is going to be absolute not necessary for you to, that is, you can't opt for 44E. The estimated income that you're going to consider is that heavy vehicles, which is 1000 per ton per month or part of month. Other heavy vehicles, which is 7500 per month or part of month or actual expenses, whichever is less. In case of heavy goods vehicle, remember, we classify as heavy goods vehicle as per the provision if it is weighing more than 12,000 kg. 12,000 kg, if it is higher than the 12,000 kg, then you are going to consider it as heavy vehicle. So 1,000 per ton per month or part of month. Even though if you have used it for one single day also, you are going to consider it as a part of month. Clear? Yeah. So in case of composite income, if you are selling a rubber, that is business income would be considered as 35, agriculture income would be considered 65. Agriculture income, obviously, it is going to be exempted. Income from sale of coffee, that is coffee curd by the seller, 25%, 75. Coffee curd roasted, grounded by the seller, it's going to be 40%, 60%. Income from the sale of tea, it is going to be 40% and 60%. This is going to be your PGBP revision.